All right, ladies and gentlemen, welcome to the Bank of Canada interest rate prep. We got about less than a minute, just so you guys can join on and get ready for it. Don't forget to share the video, like the channel, and also subscribe to it. Like the video, subscribe to it. Get the word out there. We don't have too much to kind of go through, but we do have some important bits to kind of work our way through. Whether there will be a 25 basis point hike, or could the Bank of Canada surprise the markets like they've done in the past and go for a pause instead with an interest rate decision. So let's go through stuff with what the Bank of Canada rate decision is and how that affects the market. So with the Bank of Canada, or like any other central bank, they usually meet every 6 to 8 weeks, okay, or about 6 weeks usually. And what they do is they decide where to set monetary policy, where to set the interest rate, and whether or not to provide some form of forward guidance to the markets or to the government or to the markets in general. Now, how does that affect the currency, stocks, and bonds? Simplest way to think about it is that if you're looking at the stock or the currency market, you will know that when central bank interest rates are raised, that usually raises the value of the currency as well. Now, if we get a higher than expected bit of data that comes out, maybe a higher than expected rate from the Bank of Canada, let's say they don't go for a 25 basis point hike today, let's say they go for a 50 basis point hike instead, then that will lead to the currency seeing a big move, potentially a bigger move towards the upside, because if you invest in the Canadian dollar or in bonds, then the money that you would be investing in would be worth more. Okay, with the stock market, obviously, if you have a higher rate of interest, that means businesses have to pay more for the loans that they take out, or have to pay back more for the loans that they currently have if the rate changes, if they don't have a fixed rate for paying back debt. So what happens is that the stock market sees a movement towards the downside and a depreciation as well off of the back of a higher rate of interest, or higher than expected rate of interest. If you're talking about how the markets would react, right? In the short term, you have the long term. It would hurt companies and businesses with their loans or credit that they have, or their productivity if they need that money to be more productive. But in the short term, with the markets, if the rate is raised as expected, you might not see too much of a reaction. More or less, you'd be looking towards the monetary policy statement and what the central bank governor says in the press conference that usually comes after, maybe about usually 30 minutes after the rate has been delivered to the markets. So that's how stock markets would react. They wouldn't take it in a good way if you do see a higher than expected rate of interest. But let's say if we do get a 50 basis point hike rather than 25. For the bond market, it's very easy to understand. When bond yields or when interest rates are raised, that raises the value of bond yields and causes bond prices to depreciate. Remember, what happens is if interest rates are raised more than expected, then what you can have is that markets or bond traders would start to anticipate maybe a higher rate of interest if the market has been, or if the Bank of Canada surprises the markets with a higher than expected rate of interest. Usually, when bonds and interest rates, the only reason why interest rates would be, why bond yields would react in a positive way is, one, during the tightening cycle when interest rates are expected to be on the rise, so markets will be pricing in a lot of that beforehand. But outside of a tightening cycle, when everything's kind of normal, there's not a lot going on, and you do see a better than expected, you do see the Bank of Canada presenting a better than expected outlook for the Canadian economy, bond yields can rise then as well, because bond prices will be low and the stock market will see it, or could take that in a different way and say, okay, the economy can weather a big old recession or a storm, and maybe that there isn't a need for a need to continue raising rates that much to try and balance out the effects of raising rates and kind of keeping them, maybe not raising them by that much. That would have a detrimental effect on the economy. So all in all, for currency, high rate of interest is good, a low rate of interest is worse. Stock market, high rate of interest is worse, and low rate of interest is better or lower than expected. And the bond markets, bond yields prefer a higher rate of interest. Bond prices don't. They prefer a lower rate of interest because then bond prices can go up and bond yields go down. That's a simple way to kind of think about it. But of course, there are other bits of sentiment too on what the markets are anticipating that will have a wider or could have a bigger effect on the markets overall that we need to be aware of, and then we'll go through today in the video. So, where is the economy at the moment in Canada? Well, first of all, inflation is the big target for every central bank at the moment, still is. CPI was at 6.3% versus 6.8%. GDP quarter annualized rate at 2.9% for the third quarter versus second quarter of 3.3%. Employment change came in very strong in the last report that we had, which a lot of analysts and investment banks are citing that could sway the way for the central bank to maybe go from, rather than looking to pause rates, but in actuality to maybe raise them by 25 basis points instead. Employment change was at 104K versus the prior of 10.1K. Average hourly earnings more or less unchanged, but just a tick down 5.4% from 5.5%. Unemployment rate was at 5% versus 5.1%. Retail sales was also better than the previous as well, 1.4% versus minus 0.5%. PPI year on year, also seeing a decline in inflation from the producers' side, as well as 7.6% compared to the prior of 9.7%. And then the raw material price index was at minus 3.1% versus the prior minus 0.8%. So just to kind of summarize that there, right? These are important indicators that the central bank is more or less looking at. You have the inflation aspect, okay, with the CPI, average hourly earnings, and the PPI. Okay, then you have how well the economy will be able to weather the storm, or how strong the economy will be. With first of all GDP, the quarter-on-quarter annualized data, okay, and then whether or not employment is strong in Canada, okay, and looking at the unemployment rate, and then consumer spending, a bit of that too is also comes through as well. That's important. The retail sales. These are the key points for what the central bank would probably be looking at when deciding where to set monetary policy. So hopefully everyone understands that. Don't forget, share the video, like it, subscribe to the channel, get the word out there. If you find this useful so far, get the word out there and get people to jump onto the video. Now, the previous Bank of Canada rate decision that we had on December 7th. So a 50 basis point hike was taken to 4.25% from 4.375%. That was as expected. That wasn't a surprise. The only thing to kind of note from the Bank of Canada rate decision that we had were these comments here from the Bank of Canada. They had said that the 3-month rates of change in core inflation have fallen, indicating that price pressures may be losing steam. Then you have... Oops, I had some tuner on the microphone. But yeah, so they also said that we're considering the need for additional hikes to combat inflation. Canada's economy is expected to stall through the first half of 2023. So the reason why the central bank has taken a step back in raising their rates from going, doing a surprise 75, surprise 100 basis point hike, right? Going to smaller rates is because they feel that inflation is more or less going to manage itself to a degree that the central bank doesn't have to do that much more with monetary policy. They get to their terminal rate and then they kind of just sit and wait to see how the market and how the economy reacts to the inflation data, more so how the economy would react. They wouldn't be interested. I mean, of course, they would have an eye on what the Canadian dollar is doing, because then that could add to inflation pressures for Canadians. But more or less so seeing how the markets, how the economy reacts to, or how inflation reacts to a pause or potential pause later on, pretty soon maybe, from the Bank of Canada. So that's what the Bank of Canada said in their rate decision last time. Then we're looking at Bank of Canada views from the you don't really get a lot of comments from the Bank of Canada. They more or less happen at the press conference that we'll get later on today with Macklem at 11 a.m. Eastern time. But what we had last time round is, well, on December 8th, you had Deputy Governor Kozichki, and that we are shifting from deciding how much to raise rates to deciding whether to hike rates at all. I.e., if, we've more or less done our role, but have we done enough of a job to kind of say we don't need to do any more? Okay. So they also said that if we are, they also said that if we are surprised on the upside, then we will continue to be forceful. So if we talk about inflation figures where, you've had, just like in the US, where you've had a surprise where data was expected to be in line with expectation or more, but then it was higher than expected, then the central bank took a more forceful route in the US and took a 75 basis point hike rather than going with what people may have thought might be a 50, but that didn't happen. So with the Bank of Canada, it's going to be the same thing. If they do get an inflation read that is, let's say, much higher than the previous figure, okay, then that could cause them to think, well, we might need to do one more hike just to kind of dampen the mood or dampen inflation just a little bit more and see what happens. So that's how you should take that comment there from Kozichki. Then Macklem said that the Bank of Canada missed the mark on rising inflation, but a turnaround is near. That was according to the Globe and Mail, an interview that he'd done as well. So again, that's why they taken a surprise 100 basis point hike back last year, and also continued with and did 75 basis point hike too in the past. So that's another thing as to, the central bank or Macklem more or less trying to make up for what had happened last time round, and saying that, we've more or less done what we need to do. But he does understand that they kind of underestimated, or they did underestimate inflation and how strong it would be. Then on December 12th, he added that if high inflation persists, much higher interest rates will be required to restore price stability, and the economy will be forced to slow even further. Next spring will provide much clearer evidence that inflation is declining. So if we continue to get inflation prints that are, first of all, lower than the previous figure and also lower than expected, first of all, the markets, if the figure is lower than expected, we'll take that in great stride for the stock market. Of course, the currency wouldn't. But for the central banks, they would want to look for the previous or the actual figure to be lower than the previous figure to kind of cement that their job is done. All right. Also, one other, let me go back to that actually. So next spring, or this spring, saying that it would provide much clearer evidence that inflation is declining. A lot of what the other central banks are talking about too, it's the spring time, whether or not they need to, more or less, they're working together is what you see from that statement. We've had comments from the ECB members, some ECB members looking at the summer, or maybe want to start pausing rate hikes, or maybe reaching the terminal rate in Europe. Bank of England, not so clear as to where they're headed, but looking to do maybe smaller rate hikes. I think the next week they're still looking for a 50 basis point hike instead, but that's yet to be seen what the markets are kind of looking for with the terminal rate. And in the US, you have some members looking for early signs, or have already said in the past that inflation may have peaked and is what has peaked and is headed downwards. Then if we carry on, so sentiment and views, this is quite key too. So January 17th, we had a Canadian money markets which saw roughly 73% chance of a 25 base point tightening by the Bank of Canada this month, up from 70% before the CPI data. Of course, as said, CPI data came in lower than expected, and you had seen that reaction there from the money markets. So then if you carry on as well, so this is the other interesting point too. Now, from the jobs data that we got from Canada, okay, same week or same day as the non-farm payrolls data, major Canadian banks flipped their bets to a 25 base point hike after the smashing jobs data. So remember, we had jobs data in Canada, it was 104k for the prior month. That data, okay, more or less, if the Bank of Canada's view or mandate is making sure that they control inflation, but also make sure that the job market doesn't get out of control either by raising interest rates, then that's another reason why investment banks are thinking, okay, if the Bank of Canada fears that inflation is going to get out of control or the economy starts to heat up again or starts to heat up too much, then they'll need to continue their role of hiking interest rates. So if we look at who had kind of flipped their decision, so RBC will expect a 25 base point hike, adding that impressive employment growth should tip the scales in the favor of a raise rather than a hold. So that was according to RBC's 9, who said that there. And then CBIC on January 6th, they said that with the unemployment rate approaching a record low, they're now predicting a final 25 base point raise from the Bank of Canada at its meeting later this month. And then January 18th, you have SocGen or Societe Generale that are moderating CPI together with the last jobs report. The Bank of Canada might be inclined to tighten by 25 basis points, and this wasn't completely priced in. Again, you have two bits of data that the markets were focused on. You had strong employment data, but declining inflation. So where do traders sit? And what do they decide to do? Well, what do they feel that the Bank of Canada is going to do? Vision Seek says, hello, I'm in the US and I think markets here will shift based on today's rate hike decision from Canada. Andy Bleed says, thank you for all that you do. Thank you guys for your support. I enjoy having you guys here with me. But yes, it could shift the sentiment for the rest of the market, maybe, right? The Bank of Canada has acted in the past themselves before the Federal Reserve has acted with the rate hikes. But then even then, in New Zealand and Australia, they've acted. New Zealand, the RBNZ has acted for the Federal Reserve has with raising rates by a bigger amount or taking stronger action. So that's another thing to consider, is that the Fed, could they take the lead from the Bank of Canada? Well, if the markets and Fed members have spoken about looking at 25 or supporting a 25 base point hike in the upcoming meeting, it might not mean anything. Even if they do go for a pause, well, that's kind of a wait and see. There's no clear direction that you can kind of say, okay, so is the Federal Reserve. They're going to go with the pause. There's slightly different dynamics with Canada that they're working with compared to the US. The Canadian economy has more to deal with energy prices that are their main concern, and employment in those areas. Whereas in the US, it's inflation overall in different sectors of the economy or different areas of the economy that they've got to try and deal with to try and bring down or try and hinder or dampen inflation. So there's that's also a factor too for the Canadian economy. So going back to SocGen as well. So money markets were pricing peak at 4.5% for the interest rates in by March or April. That's one thing. So of course, if we do get that today, that 25 basis point hike, then that would be much sooner than anticipated. The Bank of Canada will have to weigh a strong labour market with the fact that almost 70% of businesses now predict a recession this year, even if the decline is expected to be light. So there's also that having an impact too. And again, so the potential for a recession, does the central bank need to continue raising rates? That also adds to the debate whether or not they need to pause or not. But if the job market is strong, then maybe they don't need to go for a pause. They just stick with a 25 base point hike, and that could be the last one, like you had from CBIC saying that there. Excuse me. That was, yeah. So, or like some of the, what some investment banks are looking at. Okay. So Bank of Canada survey, January 16th, expectations for 1 year ahead inflation increased to a record 7.18% from 7.11% in the third quarter. And also the 2 year ahead inflation expectations fell to 5.14% from 5.22% in the third quarter. Inflation expectations for the next 5 years have been reduced to 3.1%. So an expectation from consumers and the central bank expecting a decline in inflation more or less helps the central bank to go with a smaller rate hike or maybe a pause. Market pricing as well. So January 6th, money markets see 75% chance of a 25 base point rate hike on January 25th, up from 64% before the jobs data. So Canadian markets also see January 17th, then roughly 73% chance of a 25 base point tightening by the Bank of Canada this month, up from 70% before the CPI data. That's repeated there. Okay, other investment bank forecasts as well. So BMO looking at a 25 base point hike. Well, actually, all of them are looking for a 25 base point hike. There are a couple of smaller investment banks that are probably not that well known that are the outliers there. But the main sentiment is the central bank is going to go with a 25 base point hike, considering how the jobs data was. If it was much weaker than expected, then you probably have a different picture overall. So this is the last rate decision that we had with the Bank of Canada. Just a recap then of what we had seen before. So if we just, so this is about 10 seconds before the last release. Okay, back on December 7th we had. So we keep letting it play. So what you'll see is that not only does the figure matter itself, but it's also what was said in the statement too. So here we go. So you'd seen a strengthening from the Canadian dollar. Now, the main reason, and we'll look at the deviations too, as to why you'd seen the Canadian dollar strengthening, is that the Bank of Canada is saying that we're considering the need for additional hikes to combat inflation. Markets were thinking, okay, they might do a 50 base point hike, and then maybe say that could be, they might be enough. But it was the fact that they said they might need to tighten for longer than what they're expected to do that moved the Canadian dollar in this way. Okay, so that's one thing to consider. So you'd seen, again, Canadian dollar strengthen in the markets. So I'm just kind of go forward, kind of see, although the data was as expected, let's go about 10 minutes. Let's keep going. See how far I can go. Okay. There we go. So the Canadian dollar, that looks to be about 10 minutes or so. Yeah, so that's about 10 minutes there. So this is how the markets were 10 minutes post the release. You'd still seen that the Canadian dollar was still quite strong as well. Kind of go back. So yeah, additional need for rate hikes to combat inflation. Inflation remains excessive and short-term inflation expectations remain elevated as well. So it was that comment that kind of sustained the Canadian dollar strength within the market. Now, if we look at the deviations then for the economic release, we've got about 5 minutes to release, by the way. Just bring this up for the Bank of Canada. Now, if you're not subscribed to the mailing list, you don't get to have access to this. That sounded harsh. You don't have any right to touch this. You can look, but you can't touch. Right. So the Bank of Canada, what is this that I'm showing you here? The deviations. This shows you how much the markets reacted to the economic release, depending on what the deviation was for the economic release. Okay, so not only do we look at the Bank of Canada, but we've also got the FOMC, which we'll have next week with the Bank of England and ECB, and then non-farm payrolls as well. So it's going to be a chock-a-block week for myself. I've done my prep nearly, but this is what we'll kind of go through and show you how the markets react to an economic release, how big of a deviation was there, or how small, and what was the sentiment. For the central banks, I look at the sentiment because it's something that's kind of easier to want to understand or pick at to say why the markets have moved. You don't have just one figure by itself. You have comments too. Then you have so this is what we've seen last time around, okay? So when the data was in line with expectation, okay, but the sentiment was what was said, or what was said within the minutes, not the minutes, the statement, that they're considering the need for additional hikes to combat inflation. That rocked the boat in favor of the Canadian dollar strengthening. But when you've seen a deviation in the figure, whether it be higher or lower than expected, right here back in July 13th and October 27th, you've seen a nice big reaction from the Canadian dollar and from the Forex market, okay, that you see here. So if it's higher than expected, you would expect, as you've seen here, the Canadian dollar to strengthen. But if you do get a statement that is more dovish than expected, where the central bank is feeling that the economy might not be able to hold up that well or is doing worse, that could then shift the sentiment in the other way or take precedence of what's happened with the rate hike or cause a very mixed, confused reaction in the markets. But more or less, you're looking for, if the rate is higher than expected, then you're looking for the data for the statement to also match that and be hawkish as well. If it's lower than expected, you expect the Canadian dollar to weaken, as we've seen here. So just remember, the first figure here shows you the initial reaction going to the wick of the candle. I always like to capture what the initial move was, right? And then this shows you in the brackets the movement 10 minutes after the release going to the end of the candle, where the candle ended. Okay, that's what I'm showing you here, if you're kind of confused by the numbers. All right, we have less than 2 minutes left to the release. So what was the biggest reactor in the markets? So GBP CAD, okay, had the biggest reaction in the past. Alongside what we've seen is the EuroCAD too. Okay, so these are the two, let's say dollar CAD, EuroCAD, and GBP CAD have had the biggest reactions in the past. That's something just to keep an eye out for. So we've got about 2 minutes left. I'm going to get my screens ready. We've got GBP CAD, dollar CAD, I've got CAD GPY. Let's get EuroCAD on. Okay, we got 1 minute to go. Let's get our TICKSTRIKE going as well. Let's get that up on the screen. Okay, less than a minute left. Canada. There we go. Right. see what this baby does. Okay, already starting to see some weakening from the Canadian dollar. Sorry, get JPY up here to see. Okay, 25 base point hike, 25 base point hike as expected. So markets, Canadian dollar seeing, well, it was already seeing movement towards the downside there. If we look at some of the other areas too, let's see what else is going on in the statement. Okay, so they said that there is growing evidence restrictive economic policy is slowing activity, especially household spending. US and European economies are slowing, but are proving more resilient than the forecast in NPR. All right, so just looking through some of the other comments then that we got here. So if Bank of Canada reiterates the likelihood of a couple of quarters with slightly negative growth is roughly the same as that of a couple of quarters with slightly positive growth. Inflation is expected to fall 3% mid-2023 and return to 2% target in 2024. What else do we have here? Risks to inflation outlook are roughly balanced, but upside risks are of great concern because inflation is still too high. Risk of severe global downturn remains, but appears to have lessened since the October NPR. So Bank of Canada raises overnight interest rate 4.5%, and they say it is likely to hold at this rate level while it assesses the impact of cumulative hikes. So looking at so more or less saying it's their final rate hike before they kind of see what else happens within the market. So again, something more or less priced in is how the markets are reacting. Not seeing a great reaction here, or a big old reaction here, but let's get the initial reaction anyways. Let's see what happened. Let's catch JPY. It's about 30.5 pips. Okay. $42.7. Still a decent move from the markets, but you can more or less say it's from before the release was before the data had been released. The markets were moving anyway, so it's the more or less the momentum from the pre-move, and then you have the sentiment or the data or the comments from the Bank of Canada, more or less confirming their dovishness with and also going to saying that they'll look to pause instead for the upcoming meeting or hold rates, and then kind of see what happens. So 35.9 pips there for dollar CAD, GBP CAD. So far, it looks like out of the three big boys that we're looking at, it's the take that back. Still GBP CAD as the biggest reactor within the market there. GBP CAD, there we go, 53 pips, let's say. Okay, so CAD taking a big old hit, well, not a big old hit, CAD taking a hit anyway, going down, but just like I said, there was movement or before the release, and then it's confirmed that it's the last 25. looking to hold rates at the upcoming meeting. We'll see what happens, and kind of assess the cumulative tightening of monetary policy. And more or less, that was what was expected by the markets. But the idea of them saying that they will pause at that they will hold and then assess the cumulative tightening more or less cements weakening in the Canadian dollar overall. So that is how that's how I can take it. I see it from here. But still, you've got a decent reaction within the market there. Okay, it's not a complete doozy compared to maybe when there wasn't too much going on with the rate decision itself. But there we go, Daddy-o. We got the press conference with Macklem at 11 a.m. Eastern time. So, FinancialJuice, or MACROACE, okay, and TICKSTRIKE. Right, we've got a load of things going on the screen at the moment, right? So first of all, let's start off with FinancialJuice, a live voice and text service. That a live voice and text service is something that the investment banks and the big boys have access to, right? They have a clear understanding of what's happening in the markets because they can see if there's a headline or the economic release that's come out, or maybe there's certain sentiment that's behind a monetary policy statement that's causing the markets to have a reaction in a certain way. They can kind of look at that and understand that. So if you have, this is something that retail traders don't really have access to, particularly if you're a day trader. You want to keep your ears to the ground as to knowing, you can see the markets and how they're reacting. But you'd also want to know why to make your trading, basically enhance your trading, okay? And change the way you kind of trade with the news as well, But it depends. Whatever works for you, that's kind of your method. That's fine. But what we want to do, so FinancialJuice, as I said, is a live voice and text service where you have, if I bring up the website here, you have your text headlines here on one page, all on one page. So your text headlines, you have your live voice feed here, okay, which plays there. You have a trial, or actually not trial, this is the free or the basic version of TICKSTRIKE, which is restricted. It isn't the full version. You have your, as I said, economic releases here on the left-hand side, so you know what to look out for in the day, whether or not there's a holiday. Of course, China's New Year this week. And then said you have all the headlines here as well to keep you up to date, and also the need to know market risk, what to expect or what to be aware of something that could or has moved the market already. Okay, that's what the need to know market risk is. That's all on one page, and we have a 7-day free trial of the Pro version. Now, first, before you say, well, let me have a go, let me sign up for Pro. Well, of course, that's down to you. But first of all, if you don't have a FinancialJuice account, or you don't have a username or login, first of all, make that account. Then you'll get an email to verify your account. Click on that, verify it. Go back to the website and log in again if you need to. And then if you want to go Pro, it'll come with like a little button here saying Go Pro. You can click on that, and you can pay for the service. Now, if you do decide to do that, what you need to do is, of course, check your email, make sure you've got your receipt. Once you've got that, then go back to the FinancialJuice website, and then what you need to do is log out or log in again, okay? And then it will give you this beauty of a machine right here, borrowing all this TICKSTRIKE stuff. There we go. All in all its glory. Okay, there we go. It's FinancialJuice, baby. But yeah, so that, as I said, even if you're on the light version, so what's the difference between Pro and light? So Pro, you have no adverts playing. There's no delay to the website at all. And you also have access to the news desk here as well to ask us questions about what to, if there is a question about what's happening in the markets, or what to expect for the day. those sort of questions, you know, you have access to us to ask those, and fire away with it. Of course, if you do have any issues with your site too, that there's also that too as well, that we can answer your questions. So that's FinancialJuice. I'm going to link the FinancialJuice homepage in the chat here. So that's there for you. Wow, we're talking about Bernie Madoff here. Bernie Madoff here. What is going on? I just kind of looked left and looked right back to the comments, and then I see people talking about Bitcoin. Sludge saying, remember to hit that like button. Yeah, that's it's quite interesting. Tiff is my Bitcoiner of the week. But yes, when bond nominees realize central banks are literally FTX. Well, they are, but they're just regulated. They're allowed to. They're not. The others aren't. That's the other way. So as I was saying, so that is FinancialJuice. Now TickStrike, we have for TickStrike as well. So if you're unfamiliar with what TickStrike is, it allows you to listen to and look at listen to the strength, listen to order flow. Okay, in a simpler way, it lets you listen to how strong or weak, how strong the buying or selling momentum is within an asset or asset classes. Okay, so this is what we call the ticker here. So this ticker, what it represents, we've got GPCAD at the moment, and what does this number represent? And this little slider here. So the number, if you have a minus figure, that represents some selling momentum, and the plus symbol represents buying momentum. Okay, now if you this slider here, what it represents, what it lets you do, this is where you control the sensitivity of the ticker. So 1 is the most sensitive to market moves, i.e. when there is a little bit of, say, there we go, buying or selling that's happening, TickStrike will pop off. Okay. Now, if you want to control the level of sensitivity and make it less sensitive, you can drag it up all the way to level 15, which is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that's occurring will TickStrike pop off. So now it's not showing anything at all because it doesn't match the criteria for TickStrike to pop off. Okay. That's what TickStrike is. So you can kind of chop and change at what level you want that to be, whatever works for you. Particularly if you're a day trader, right? If you want to capitalize on potential trade or manage your risk during the day, then you can do that with. Then TickStrike is more of an additional, again, another product that you can add to your arsenal as well to kind of use. You can use it however you want to use it. Okay, whatever you want to do with it, whatever works for you. If you've used it in the past, then great. If you've never used it, then there is a 7-day free trial for TickStrike. Okay, that is where you can have a look at there, and you can have it all 7-day trial with it. Again, if you like it, if it works for you, great. Go for the full thing. If you don't like it, then fine. You still have on the FinancialJuice website, although it's not the full mode, you can still have a TickStrike on here, but it's set at 1 level, okay, which is 6. So you can't, and you're restricted to only these 4 assets here. There aren't any other assets that you can look at. Now that'll be where you get the full version of TickStrike by itself. That's TickStrike there. Now, if you want the deviations then for the economic release, if you've gone and you've left the video, because so what you can do is sign up to the MACROACE mailing list, and that is completely free. Okay, completely free. And as said, the deviations, if you want to have access to that, sign up to that in the mailing list. I send out 1 email every Sunday. That gives you a mini rundown what to expect for the week ahead in Asia, US, European session, and also the summary of the weekend news, because I'm addicted to the news and I like to put out news on the weekend. I put that together into 1 little email. It's not huge or massive. There's no charts or graph. It's graphs. It's very simple, and you have the deviations with the live stream links for the upcoming economic releases. Okay, you don't get access to all the deviations. But if you subscribe to the main list, I just provide the upcoming economic releases that way for you. So that's the deviations. So that's how you can get the deviations there. As I said, completely free. Have a little play with it. Even if you're, so unusual activity as well. So if you like trading unusual volume in stocks, crypto, forex, okay, and futures, right? Then you can also use unusual activity to join our, again, a free beta test group. Don't have to pay for it. No money is needed for it there. Just sign up and have a little play with it. Again, the link is there in the chat. I've just put that there for you. So that is there for you. And yeah, that is, so we have, so a reminder, what we also have is the stream on Friday for US consumer spending as well. All right, so if I just link that, apologies, just away from the desk there, to make sure the boys are all good. So what I'll do is I'll also link you to the next or the upcoming economic release for this week. Now remember, tomorrow is GDP data for the US. But although we're into the US, that's going to be interesting to look at, and it'll be the advanced data or the initial data for Q4. What we want to look at is inflation in the PCE data. Okay, that's what we want to keep an eye on for the US session on Friday. So I'm just going to grab that video for you and put that in here, and the live link again, completely free. You can just hop on whenever you want to. If I just grab that here. Okay. There we go. All right. So there we go. That is the link for the live stream on Friday. But again, same thing. Subscribe to the channel. Like the video if you've enjoyed the content. Share it with your fellow traders and friends if you found it useful. And we will continue from there. But for now, enjoy the rest of your day. Thank you for joining me for the trading session. And I will see you guys next time.